Welcome to the deep dive. We've got some great material you sent over, all about different ways people approach stock investing.
Yeah, lots of different styles out there.
Exactly. So our mission today is basically to cut through the noise, break down the main strategies so you can, get a quick handle on them.
Right, give you the lay of the land, see what clicks.
Okay, let's jump right in. Value investing. What's the core idea?
Value investing, well, it really boils down to finding companies whose stock price seems cheaper than what the company is actually worth.
Cheaper than its intrinsic value, right?
Precisely. So you're digging into the financials, looking at the long-term potential, trying to spot those like hidden
Kind
gems.
of like finding something really good on sale.
Exactly that. The goal is buy it at a discount and then, well, hold on. You wait for the market to catch up and realize its true value.
So patience is key there. You need to trust your analysis.
Absolutely. You look at things like the price to earnings ratio, but you got to be careful not to just buy a cheap, bad company. It needs to be genuine value.
Right, quality matters. Okay, so then there's growth investing. Sounds almost like the opposite. More focus on potential.
That's a good way to put it. Yeah. Growth investors are looking for companies they expect to really ramp up their earnings in the future.
Even if the stock price seems a bit high right now.
Right. They might be in new industries, maybe have some innovative tech. The bet is that future growth will really drive that stock price up significantly.
So you're less worried about today's profit numbers, maybe.
Often, yes. These companies are usually pouring money back into the business, fueling more growth. Expansion is the name of the game.
Understanding why they might grow, their edge, must be crucial then.
Definitely. What's their competitive advantage? That's key.
Okay. Let's switch gears. Index investing. This one feels maybe simpler, more hands-off.
It generally is, yeah. With index investing, you're basically buying a whole basket of stocks that mirrors a market index. Think like the S&P 500.
Ah, so you get instant diversification. Lots of companies in one go.
Exactly. You're not trying to pick the winners. You're essentially betting on the whole market or that segment of the market doing well over time.
And often lower fees too, I hear.
Typically, yes. That's a big draw for many people.
Makes sense. Okay, next. Dividend investing. This one's appealing because, well, you get paid, right? Regular income.
That's the core idea, yeah. You focus on companies known for sharing their profits, distributing dividends to shareholders regularly.
So it provides a cash flow stream. It's not just about the stock price going up.
Precisely. You get that income along the way, plus hopefully some stock price appreciation too. These are often, more established, stable companies.
Okay. Now, contrarian investing.
Nah.
That sounds interesting, going against the flow.
That's exactly it. Contrarians deliberately do the opposite of what the majority seems to be doing. Buying when everyone's panicking and selling.
And selling when everyone's piling in.
You got it. The thinking is that markets, well, they overreact sometimes. Fear or greed can create these mispricings, these opportunities.
So you need a strong stomach for that, I imagine. Believing the crowd is wrong.
Definitely takes conviction. You might be buying when prices are still falling or selling when they're still rising. It's not easy.
Okay, one more. Sector investing. Focusing on specific industries.
Yes. So here, you're trying to identify whole sectors of the economy, like technology or healthcare or energy, that you think will outperform the broader market.
So it requires a bit of a crystal ball, looking at macroeconomic trends.
Well, maybe not a crystal ball, but definitely analysis. You're looking at economic trends, industry-specific stuff, trying to figure out where the growth might be concentrated.
Like betting big on renewable energy, for example, if you think that's the future.
Exactly. You make a focused bet, the potential upside can be higher if you're right.
But the risk is higher too, right? Because you're less diversified.
Precisely. More concentrated risk in that specific area.
Wow. Okay. So quite a few different flavors of investing we've covered. Value, growth, index, dividend, contrarian, sector. It's clear there isn't just one right way.
Not at all. And honestly, many investors kind of mix and match. They might blend elements from different styles to suit themselves.
Yeah, that makes sense. So as you're listening, think about which of these approaches maybe resonates most with you right now. Which one kind of aligns with how you see the market or your own comfort level with risk.
It's a great starting point for figuring out your own path.
Definitely.
Yeah.
And maybe think about what other questions you have about the style that caught your eye. What might you want to dig into next? That's your deeper dive for today.